Hello, everyone, guys. I hope you get a good lunch, and now you're full and energized to basically listen and then ask the questions to our experts. Just want to do the touch based on who are in this audience. Raise your hand if you know what RWA is. Okay, nice. Raise your hand if you know the difference between self-custody and custody. All right. Then we have a quite confident audience, and maybe please be ready to ask your questions to our beautiful panelists. And now the floor is yours. Please introduce yourself, and then maybe share one special fact so audience will be able to start talks after this panel.
Yeah, sounds good. I'm Sami. I'm one of the co-founders of Arvo. It's a property tokenization startup here in the UAE. And I guess fun fact, I suppose we'll speak about business the whole time, but fun fact, I'm half Ukrainian, half Palestinian. So I got hit from both sides. Happy to be here in Dubai. So this is a home of mine now.
Hi everyone, my name is Julian Kwan. I'm one of the co-founders of IXS. IXS started a couple of years ago as the first RWA DEX. So it was looking to create the Uniswap model, but have securities licenses for all the real world asset tokens. Latest, greatest is we've launched Bitcoin Real Yield. So we're loaning stable coins to Bitcoin holders that are reinvested in tokenized fixed income, which is the real yield in US dollars versus BTC5. Thank you.
Thank you. Emile, the floor is yours.
Yeah, thank you so much. Thank you so much, Sasha, for invitation, and thank you so much to the speakers. My name is Emile Rezbaev. I'm CIO at Object One. We are one of the leading development companies in the UAE. We are a top 15 development company by the sales volume in Dubai. And we are growing fast. As we grow fast, we raise funds through different structures, but we mostly focused on traditional ways of doing and raising funds. So here I'm happy to explore more about tokenization and how we can implement that in our fundraising.
Yeah, this is super cool. And this is why we have this conversation happen right now. We have this conversation with 3 blocks. So first, I would invite our speakers to basically brainstorm why the real-world asset adoption happening right now, why it's not happened previously. The second block is about the improvements, issues, challenges that we have right now. And the third block, we can brainstorm and predict maybe on what will happen in the future and how we can scale a real-world asset adoption. And let's start from the first one. Please, let's maybe think about why real-world adoption happening right now, why people are start talking about this beautiful world. And in this panel, we have one representative from the completely different part of the world, Emile. And I want this conversation to be a little bit more spicy, so our experts will share their vision, and maybe Emile on his side can maybe somehow challenge the vision that we are sharing. So yeah, who wants to start and think about this?
I can go. We started in 2018, so that was the very beginning of RWA. It started as security tokens. At the beginning, there was no infrastructure. We were one of the first. You have to spend years getting licenses. All the assets were private assets, so startup shares and real estate funds. Very hard to scale. Mad confusion, regulation challenges, uncertainty, and many other issues. The reason we're now talking about RWA in such a strong narrative, probably the strongest narrative in all of the crypto subsets. A year or two ago, people started tokenizing treasuries on-chain. And there's about $200 billion of stablecoins earning 0 yield. So kind of ironically, or up until that point, no one had thought about it, that the first product market fit for RWA would be the most liquid asset in the world. Because everyone used to run around saying RWA is liquidity for liquid assets, which is not necessarily true at all. So that was the real first finding yield for the on-chain stablecoins, and which has then grown into money market funds and now private credit, and now the whole world's lit up with commodities and everything. And the other major change has been the US government doing a 180 and saying, we're all in on everything related to blockchain. So Singapore was pro 10 years ago, 5, 6 years ago. Now Hong Kong is pro, at least from Asia, Japan, Korea. So this has been the kind of the evolution the short evolution of why these real yields, and also I think that the DeFi yields are there's always moments, when you're giving more of token A by staking token A, and it all works on the way up when the price is up, and as soon as the price starts falling, everything falls apart. So there's a couple of different things, but I think, and ultimately the U.S. Secretary, so I'm a bit tired after all this. Treasury Secretary, he said we're printing trillions of stablecoins, and the Genius Act in America says it's illegal to give yield as a stablecoin issuer. So they're basically guaranteed trillions of dollars of stablecoins that are earning no yield, that unless they go and buy a yield-bearing RWA.
Yeah, I would agree with you because basically adoption happening not when people are or we are starting to tokenize assets. The real adoption happened when investors are actually interested to invest into these tokenized assets.
Yeah.
Sami, do you want to add something on that part?
Yeah, I think it was a really good point about, when the market's going up, on-chain, the yields are great, everyone's profitable, the returns are high, they're incomparable with traditional markets, they're always higher. But when, we saw a large retracement in 2022, I think there was a general push towards coming to what has historically worked, right? Putting assets with actual off-chain demand and have off-chain cash flows, putting those on-chain and giving access to what maybe underserved or users in geographies where there's little access to brokerages, access to those assets, to those yields. And I think also, generally speaking, dollarization has been sort of on the rise, specifically, led by the treasury agenda that we've seen in the past several years. And I think that will only continue to grow with stablecoin dominance. You all sort of see how stablecoins are mostly denominated in USD. There's a lot of local stablecoins available on many markets for local FX and local off-ramping, but it's generally a game of the US dollar. And as fellow panelists here mentioned about sort of the idea that the yield will always stay within the issuer and will not be distributed through the Genius Act. I think that's a strong sort of point to it being a very lucrative business as well. So I think that will only continue to grow, and I think we're in the first innings of that revolution.
Yeah, one more thing that I want to add on that, maybe just you started when it was 2018, right? And even before, there was not really the blockchains that can really execute the opportunity to issue that. So maybe we're also blockchain ready for that part as well. Emile, we think that the real world adoption happening right now. What do you feel? How do you feel? How basically the real businesses are right now reacting on that part? Or what's your vision on that, being not in crypto industry?
Yeah, actually, let me share a few observations and questions. And apologies in advance for my ignorance about this field. And hopefully, Julian and Sami will, shed some light on this market. A few observations which are made during, working in real estate in Dubai is that we've been reached out by a few counterparties which are now tokenizing real estate, like Mantra, Propcom Mint, which tokenized a few real estate units. The first observation is how big is the market and how much liquidity can accommodate and can digest this market. We, as a company, we operate at a scale of we are turning around hundreds of millions of dollars every month, and it seems like at the current stage the market is not deep enough to enter at this stage. So we are kind of now just waiting for what comes next. And second question is adoption and regulation. So far as I see, that the regulation doesn't really follow the speed at which the market operates. And for example, understood that in the UAE, it's been allowed to tokenize only ready assets and ready units, while off-plan is still not eligible for tokenization. But at the same time, off-plan of the market in the UAE is huge. It's hundreds and billions of dollars. And third question I have in mind is that what kind of benefits it can bring to us comparing to traditional fundraising instruments. For example, if we are raising and do fundraising for our projects under different structures, but mostly apart from off-plan sales, we are dealing with ultra high net worth individuals, family offices, and funds who finance at the project level. And for us, we can control this process, and we do have visibility. And for us, we can raise $20 million by just making a few calls and then running a process for a few months. comparing to tokenization and how long it will take, and we're not sure about the outcome of this process, whether it will be successful or not. So this is my three, I would say, key questions on top of my mind.
Guys, would you like to follow up on those questions?
Yeah, sure. I think from the sort of benefits of tokenization, like it's a technology that we are only now seeing actually come to market specifically in the UAE. It's not something that we've seen really get adopted anywhere else in the world from a real estate perspective. And the main reason for that is because of regulation. Because usually only the company that owns the property is being tokenized, the special purpose vehicle, whereas here there's a actually property tokenization sandbox that's specifically moving in the direction of building out a framework that allows the title deed to be tokenized and put on chain, which gives access to, of course, there's high net worth individuals. There'll always be sort of a specific approach to dealing with that specific sort of customer. But when we're speaking about retail clients and investors who are just basically priced out from their ability to participate in real estate, I think tokenization and splitting the larger asset into small bits gives a massive unlock for these users who have been historically underserved in that direction and only getting access to real estate through debt and mortgages, which I think is a great vehicle as well, but it's just a very, very different style of participating in the market when you're bound by an interest rate versus you being able to hold equity in the property directly and see the upside from the growth of the market without having to sort of pay an arm and a leg for it.
Yeah, I think, historically, those that thought tokenizing an asset meant free money falling out of the sky like it's an ICO have failed dramatically. Just because it's on a token doesn't mean you don't have to do any work and lead the project and raise the money. It's a digital share versus a paper share. All your work remains the same. I think we like to think about it or explain it to issuers, and we've seen thousands of projects that haven't worked. What's the real value proposition? What is better about this than a paper version? Is it tradable? Can you use it as collateral, et cetera, et cetera? And that's where you're seeing the real, the next dimension of value coming from these tokenized treasuries, where people are actually, Binance just announced they would allow people to put the BUIDL treasury token as collateral to borrow to then stable coins to go into the crypto exchange. So that's a very good example of, well, that treasury token is way better than your, call it, paper treasury share that Binance won't accept. So all the rails are moving on chain. Depends what industry. It depends, what industry you're in and what jurisdiction you're in. We tell issuers as well, like, if all the US dollars vaporize from paper to digital and you're not sitting there with your asset on chain, no one can buy it, right? If you're going to try and shove a stable coin into a paper offering, it just doesn't work. So there's a mandatory need for long-term companies to understand what's going on and put them on chain. But putting your asset on any platform as an RWA, it doesn't change the fact that before you've been there, no one knows you. The people on there are potentially from all over the world. If there were no tokens involved, what would you have to do to sell them something? And you'd have to do all the normal things, right? Zoom, roadshows, investor relations. So you've got to build in multiple use cases and thinking much further down that line. The return of the investors are getting the real world asset. If the real world asset sucks, no one's going to buy it, whether it's on a token or a paper. So it has to have a great company behind it, like all investments. And then if you can build in those multi-dimensional use cases, then you can win. And if you can build in daily liquidity to any private asset, then you can win. Because the two characteristics that have proven to win in RWA and is so far has been yield, but daily redemption, daily liquidity, because you're competing against crypto. So if you can marry that daily liquidity with any asset, you'll get some uplift. That's my take.
Yeah.
Let me just probably follow up. So, Julian, as you mentioned, there are two key things as far as I understood: the yield and the liquidity. And based on my understanding, to make the market liquid, you should have big players. Like, for example, when you do IPO of any public stock, you should bring institutional investors on board, so they provide enough liquidity. Retail portion of any successful IPO is within 20 to 30% range. All the remaining part usually covered by bigger tickets provided and bigger liquidity provided by the institutional players like family offices, funds, and so on and so forth. And how is it going, and what is the situation nowadays with institutional money in this market, and how big is the liquidity provided by these players?
Yeah, well, I think we started with like a couple $1 billion into these treasury tokens, which, I mean, people who don't know, the Biddle BlackRock security treasury token, it's a minimum $5 million investment. It's not for most of crypto, hedge funds, treasury. So yeah, that's proven to tick all the boxes in BlackRock and treasury and all this. But I mean, there's a lot of different assets, a lot of different angles to look at it. There are other assets that are working that have, people like in these tokenized stocks, because if you're in Indonesia or Nigeria or all these countries, you can't buy the real stock. So there's just a real use case that people can access these stocks. So it really depends what it is, but yeah, bigger has led the way so far. But and it's not just yield now. There is a couple $1 billion of tokenized gold out there as well, and everyone's coming on chain. But it was really Larry Fink and Wall Street saying this is legal, this is what we're going to do. It's all going to be on public chains. And there's like 35,000 other asset managers that haven't launched a thing yet. So it's still very early, but it's good that we got that PR push.
We already touched a little bit the challenges, so we're now slightly moving to the block 2. We discussed the compliance challenges, the challenges that we are forced with by basically building the institutional ready real-world assets infrastructure. One of the things that also I have in mind is basically the cross-chain liquidity. So we see that the concentrated liquidity right now happening only on the EVM compatible chains, mostly Ethereum. How do you see we can solve the issue of the cross-chain liquidity in general? How you are guys solving this issue right now? Is it basically an issue right now for the on-chain tokenized assets? It's one thing, and I will follow up maybe later on that.
I mean, we're not specifically solving the cross-chain issues of liquidity, but I think you guys are doing a great job with
that was my comment on that.
I'm assuming that was a little layup for that.
Sure.
But generally speaking, I think that the real-world asset sector generally needs to have a very clear understanding of utility, right? So when you're approaching a conversation with a traditional financial manager who is looking to allocate to sort of an on-chain asset, there needs to be a very clear distinction. What specific improvement am I getting over the legacy system? And I think the cross-chain liquidity component is unbeknownst to someone who doesn't know of a sort of on-chain asset in the first place. So that sort of is the back end that just should work and should aggregate liquidity and should, quote unquote, be better, right? If it's not better, then unfortunately there's very little argument to make, unless there is a brand new set of utility or a different return pattern or a different product that the specific financial manager can get access to. I think these are the prisms through which we should analyze these subjects.
Yeah, Julian, just want to maybe ask your opinion. I know that you're building mostly private, basically privacy layers for the real world tokenization. Is there any issue for you, like in terms of the cross chain?
Yeah.
Like,
so.
And also like another vision, quick on the private / self custody approach. Like why you have chosen this direction?
Well, so we have to KYC users because that's how you've legally got to sell a security. Mm-hmm. That's not done on the blockchain level.
Yeah.
So
I see.
What's interesting now is that has been a challenge, right? If everyone's got a KYC on a different platform, how do the tokens trade? So what the industry's decided is to kind of adopt a DeFi model now. And this is quite interesting because this is very new. People are issuing real-world asset tokens, securities. They're KYCing the first person. Otherwise, they'll lose their license. And then basically saying, you're not allowed to sell this to anyone. We'll write that in the contract. But, if you kind of take it off to a DeFi pool and start selling to other people, whatever. And so then the only time there would technically be a problem is if someone came back to redeem and they hadn't KYC'd. If they could pass KYC, they could redeem. But now you're starting to see the Biddle token and these tokenized stocks floating around in DeFi pools because the problem, because no one's coming to redeem it.
Yeah.
So that's kind of what's happening in the industry in terms of, and then cross-chain and all this, like people have just gone back, instead of all these standards about 3643 and all these other standards around who can trade. It's like, let's just go back to the old ERC20 because that's the most permissionless structure, and let's see what happens after a while.
Yeah, that's what you mentioned about the KYC. On our end, I'm presenting this DeFi on-chain tokenization infrastructure. We are basically the platform who providing for the institutional clients the opportunity to trade on-chain and DeFi in self-custody way. And the way how we solve it issue, yes, you're right, we are not KYCing the users who is entering to the platform, but we're KYCing the B2B clients who providing this liquidity, who bring in the liquidity on-chain. So like the way how it works is that, like, for example, you want to trade Apple asset on chain, on EVM or on BNB chain, you as a user won't be KYC, but those who are providing the liquidity for this swap from Ethereum to general asset is kind of doing the KYB. That's the way and the approach that we are following right now. But I got you, and maybe moving forward, we might see the requests like by license, by getting the certain license for this certain service provision. Hopefully not, but this is the way how it's executing right now. I believe I would suggest you to basically brainstorm on how we can improve, or how we can scale the real world standards, how we can how we make the real world assets the standards for the institutions. And maybe to comment what exactly you are working in your projects in this direction, why you're working, and then we can ask Emile on his opinion on that.
Yeah, I mean, from the institutional perspective, I would probably pause, but on the retail perspective and actual general public participation in on-chain assets, from our end, we're building a platform specifically for the tokenization of real estate and democratizing access to residential properties in the UAE. That spectrum of products that we'll be offering will be increasing. So we'll be building out debt products, we will be building out trading products, we'll be offering commercial and pre-construction properties once the license permits that. But what tokenization in and of itself allows is for access to those specific assets, right? It's the platform that we will be building through a tokenized basis where the ownership document is actually on the blockchain. Anyone can technically participate in the purchase of it via a filtration mechanism of KYC. Of course, by license, we have to enforce that, as it was also mentioned previously here. But the sort of limitation of KYC isn't something, generally speaking, that is a blocker for most users in the globe. It's the ability to access the underlying security or underlying asset that is the issue. So if we put these assets on chain and be proactive in giving more opportunities to the general public and being able to access assets that they are usually not able to access, we are by definition creating a new opportunity for a populace that's previously never seen it. So for us, I think we're trying to be proactive, putting these assets and pushing the narrative, pushing the exposure of these products as much as we can. And we do believe that the demand will simply follow.
Julian, would you like to?
Yes, so I mean, look, institutions want to make money as much as sort of retail traders. So, I mean, but they've got a lot more rules. So I think, onboarding these institutional assets takes a couple of months, even if you wanted to snap your fingers. Look, but ultimately now, I think that it's all been more of a regulation hurdle, especially from the US. So now they're all coming in. BlackRock wants everyone in the world to buy their treasury token, and so does Franklin Templeton, and so does whoever. So the issuer side is pretty straightforward. They just want to go to as many legal platforms as possible that has the first rail of KYC and sell it, and then they've got their money. And whatever happens, what the platforms or the users choose to do after that, up to them. So I think, now you've just got to do things that they're never going to go trade on a DeFi platform and plug in a MetaMask wallet and away they go, because they've got to answer to people. Look, I think there's enough infrastructure now globally. There's enough positive regulation. Everyone on the sidelines who's waiting to be able to start or do something without getting arrested or whatever is now sort of got the green lights. Abu Dhabi's giving Binance securities licenses. So now we sort of flip, I think, to get into that, all the regulators pushing against it to be like, now, in this world of digital assets, people can get up and go anywhere, and people are buying and selling anywhere. So for the first time ever, regulators are really competing much more closely. Because if you regulate if you give Binance a license, he'll run 300 million users through that platform here.
Yeah.
But anyone could have given that license, but they just didn't do it. So other people didn't do it. So I think it's all positive, and I think that this is the next wave, right? This is not the retail Bitcoin bull market. It's the institutional market, and then RWA has never been retail. People in retail are buying and selling utility tokens of RWA platforms like Ondo token, like IXS token, it's our utility token, thinking they're buying real world asset tokens, which they're not. They're buying crypto. The equity, the $5 million minimum check equity token behind the platform, that's the real world asset equity token. And so there's actually two completely different markets in RWA. There's the crypto token RWAs, and then there's the actual security tokens behind it, which is another layer of
tokenizing Mango or like real bonds. It's two different markets, but still both. Emile, what do you think?
Yeah, actually, it's very important indeed, that the QSC is run in a proper way. An observation from my side is that, given as far as I see, the market is still emerging, and even though Julian has been dealing with this since 2018, anyways, the market is new and it's still a new product. And I would say that it's very important that the system is challenged and challenged through crises. And the real challenge will, I would say, probably can help to test the system, how work it well, whether it works well under kind of negative circumstances, rather than just like when everything is growing, when S&P is growing, and how the real regulation might approach and might address the real challenges. So I would say I would expect that like it will take a few cycles of the market to test and challenge the system, unless it's probably will be approved by the institutions.
But what makes, like, for example, we have already the solution that potentially can bring you new clients, new liquidity. What basically stops you to start adopt this technology? What exactly your vision on there?
Yeah, I would say that all the funds and basically most of the people, when they take a decision where to invest, they look at your track record. And track record of the market, and track record of the people who are behind that. And as we speak, currently, and again, apologies for my ignorance, but I have not really captured and have not seen really good examples of tokenized kind of real estate assets in this region. I know that there are some in like, for example, St. Regis done some tokenized. They tokenize a hotel. So I would say that we. As everyone, like, it's very important. The opportunity cost is so high, so you always like question yourself whether you should spend a lot of time to investigate and to explore something, rather than just doing a traditional thing which you done before many times and just replicate it.
But can we just think about the criteria that makes this solution good for you? You mentioned that there is no good examples on the market, but not maybe like from your personal perspective, but maybe brainstorm on what are the good solutions that allows institutions to go for it. Because we already have this examples when BlackRock already tokenizing this access, meaning that they find something fruitful for them to go for it, and now I don't think it's a big hype for them. They are just, I believe they have the strategy behind. So, like in terms of the real estate market, maybe you can share the expertise on like you can, share the summary of this market in this certain region where you're focusing on in terms of their investment, and why people are now choosing to invest like for the GVs instead of like going and buy the portion of their bathroom in one of the upcoming developments in the market.
Yeah, that's the thing.
I'll help him out. Like, no one wants to be first; everyone wants to be second.
True.
So that's one of the main reasons.
True, that's the thing. And unless for example, and you should solve some issue. For example, Damag, they've done this tokenization. They've done that because they have a lot of stock, which is ready stock. Like, and there are just a few developers who are holding this massive stock, and they need to find a solution to monetize it. That's why they, they decided to allocate a lot of time to kind of do this through Mantra. For us, as we speak, we've just, I would say, as we speak, and we find a more efficient way to address our liquidity kind of challenges and to do fundraising in a very kind of traditional way. And indeed, we don't want to be first, and we don't want to have a risk of failing, because if, for example, we run the process, and then it doesn't come to a good kind of output which we expected, it might affect the reputation, it might affect the perception, and of course the ticket size still given tokenization. For example, I've just done some research and I realized that the RWA market is $30 billion. Just probably correct me if it's not the correct figure, but that's what I came up. And just to give you some understanding of it's global RWA market. While if you think about real estate transactions in Dubai itself for last year, it was $150 billion. So ultimately, the full global RWA market can be digested with Dubai market within just 2.5 months of running.
Still early.
Yeah, and I think it's generally a great point, but I think it points actually to the fact of the opportunity of growth. Because in the end of the day, if the current market size of volume per year is $150 billion, and I'm not sure in the figure, but it seems like the global sort of real world asset TVL per se or value definitely is not as high as it could be. Maybe we should point to some of those bottlenecks, right? And I think one of the bottlenecks here now is being solved, right? And that is on the regulatory perspective, where the ability to tokenize real estate has kind of been half built yet, because there aren't really sort of public interfaces for investment into these vehicles. It's only starting up, like it's in a sandbox format. So I think the good conclusion for the story in this sense is that we're seeing the opportunity, we're seeing the difference in size, and then there's a clear misalignment in these figures. Hence, one needs to grow, or we're unfortunately then we're misaligned in the goal of real world assets, right?
Yeah, definitely. I do believe actually in this market, and that's the reason why I'm here. But I think, as Julian rightfully mentioned, that no one wants to be first, and we're just absorbing what's happening with other people doing the same. So, and then as soon as we see that the infrastructure is in place, as soon as we see that the liquidity is in place, and we see the good cases, where definitely everyone will jump in.
So we talked about the scaling. We talked about basically issues and challenges. Maybe we can talk also about the predictions and talk maybe what is the next. How do you see the real world assets future in the next 2-3 years, guys? What are the ideal future for you?
Yeah, I mean, I think we can ponder a little bit as well. I don't think we have a crystal ball to sort of predict it, but there's a plethora of thinking of whether the DeFi vertical will converge with the real world asset vertical, whether these two things will live separately and the blockchain just provides access and the composability of public infrastructure for real world assets and never really interact specifically with DeFi. We're seeing how that is developing, but my personal opinion on the matter is DeFi is sort of a concept of a spectrum, right? It's a permissionless access mechanism, and the spectrum of products and actions that technology allows might have a lot of overlap with real world assets. Will it have a complete unity and live in unison? Probably not, because there are a plethora of requirements on the legislative perspective that is required for these real world assets to be available. But the story is going to be very interlinked, and we're glad to be participating in it.
Yeah, I think we're at the real turning point for the industry. We always believe that, like all the rest of our activities, we all live on apps, and investments have been living on platforms for a long time. Your stocks are on interactive brokers, your cryptos on Coinbase, and we always believed the real world assets would bring crypto and the real world together. And sit at the nexus of both. And you're now seeing that the crypto exchanges are rushing to get licensed so they can add real world asset tokens next to crypto, because it's a much bigger universe. There's way more real world assets than crypto, but it helps crypto. It gives it a real use case, and we've seen so many things in crypto that have had no use case, speculation, whatever. And then so you've got all the DeFi guys now coming towards RWA, and then you have the TradFi guys that are already in RWA. They're coming for it at the same space. So it's now like game on. We've got certain parts of the market, world, industries, etc., where things might not have even started yet or are still trying to convince the first players. We've got the other side of the spectrum where Binance wants to put real-world assets in front of 300 million users. Like, you need to have your asset on chain if you want to be even in that discussion, right? And they're going to come for everything. Private equity, stocks, everything. So it's very exciting. I think we're going to, I think the next biggest asset class for RWA, real estate, yes, eventually. We started as real estate only before in Web 2, and as soon as I started having those discussions 6 years ago, I very quickly realized we need to expand because we can't wait for the real estate world because they're notoriously slow to adopt tech relative to other industries. But private credit, we've seen the winning RWA. It was yield-bearing, instant liquidity, US dollar, treasury tokens. So if you can get a higher yield with all the same DNA, that's going to win, and we're going to see trillions of stable coins. But then eventually, property titles, they'll all go on chain. Everything will just be on chain because there'll be no other way to do it. It's better for regulators. It's more clear. It's instantaneous. So one by one, got to take a long time. But the paper world and the on-chain will kind of coexist for quite a long time to go. But yeah, very, very exciting times right now. Being on panels, we used to get laughed at. There were no RWA discussions a couple of years ago. So yeah, it's great time to be in the space.
Yeah, I love it. Yeah. Emile, when do you see what is the future for real world assets from your aspects?
Yeah, actually, I'm not an expert to judge, but I just can share a few thoughts, which would help me to really to gap this bridge between, I would say, the business and the real world assets. What I would be happy to see in the coming future is government being, as also Julian mentioned, that the government being really adopting this themselves, not just a few private players, but to see it at a large scale, and to see that the regulated and government or government-backed companies they are enter this market. That would be a good sign for me to also have a big look.
Great. So, guys, we have some time for the questions. Do you have anything that yes, go ahead. Yes, please. Yeah, let's stop here. Yeah. So there is a few players on the UAE market that are already doing tokenization for the real world assets, and basically the question to Sami, how can make things different?
Yeah, I think one of our strong points is that we don't have a strong background in real estate. We have a very strong background in financial technology and digital assets, and we're building an investment platform. And for us, that is something that is of the most importance. Building the user experience, building the supply side, building the product itself for the utmost experience of the investor, versus focusing on the supply side of the real estate and having that background. I think that is one distinction. And also, we are a very neutral platform. We don't come from a real estate background. So we don't have associations with certain developers or certain brokers. We're open for business for all and for everybody, and we would like that to persist forever.
Thank you. And the second question to Mr. Kwan. Yeah.
Sounds like I'm in trouble, Mr. Kwan.
Trouble. It's just a few things I picked out from what you were saying. You want to democratize access to RWAs, enable them in the emerging markets. Something that Emile actually said was during IPOs, I think it was 20 to 30% is being held by retail. The rest is institutional. You also mentioned that you have to do KYC, and there is a, let's say, compliance overhead. So my question to you is, what is the business that you see in the emerging markets, considering the fact that most liquidity comes from institutions, mostly in the US, and that the overhead for compliance is actually very high. So let's say someone's Nigeria is purchasing $5 worth of an RWA, but it costs $1.50 or $2 to actually KYC them. How does the business work?
Yeah, I mean, it's a good question. I mean, I think it's emerging markets. It's going to be much easier as a big player. So there are crypto exchanges and fintech platforms, payment companies that have tens of millions of users. So some of them are already KYC'd, and then it's a scale game. So I think that it's really interesting value proposition. We've been wrong many times. When we first heard of tokenized stocks, we're sitting in Singapore being like, what's the point of that? I can buy it on 5 different platforms. And then, a little bit of research, and it's like, yeah, but billions of people can't buy these things, right? And it's much easier for billions of people to get a digitized dollar now on platforms, because otherwise they have to get a real paper dollar or open a bank account. Is impossible for literally like a lot of people just don't really understand. Billions of people are not able to open a US dollar bank account. So there's different angles, but that's like a whole new asset. That's why crypto is also so popular in emerging markets as well, because it allows the average person to do their own thing and be part of it. But yeah, I mean, it depends which market. I think that this accessibility is truly, and democratization is really real in those markets. Maybe more so in those characteristics than in maybe developed markets like America, where retail do have access to many different financial products. But yeah, all in all, I think massive net positive to emerging markets, and very positive for those jurisdictions.
Thank you. Anyone question? Yeah, we have one more. Yeah, we have time for just one more question.
Okay, hello all. This is Arash from wallet.com. We have developed a non-custodial wallet. We have launched 1 month before.
Yeah, but the question.
Sorry?
What is the question?
What's the question? Okay, we have launched it. We have got more than 100K users in less than 1 month. But I have the question that what is the good and what is bad for getting investment from the VCs or getting investment from the normal people? Because I'm in crypto space, for example, from 2015. I have many trustful friends that can, for example, give me the money. I also have millions of dollars, but FTX, I lost many money in FTX.
Yeah, we got it. Yeah, maybe it's
Yeah.
not really related to the tokenized assets, but guys, do you have any thoughts on why they're just investing from the family offices or from the P2P users
or venture
versus
thank you.
Yeah,
Thank you.
versus institutions and VCs?
Yeah.
I mean, I think the risk appetite of all of these varying capital allocators is different. The long-termity of their investments, some of them are, retail users like to be a little bit more liquid, a little bit more short-term. Obviously, VCs are long-termist, right? So it really depends on, I think, the horizon and the risk appetite. And of course, in the end of the day, the product that is being built at hand.
Yeah, I think, the first round for many startups is friends and family for a reason.
And angels.
VCs can be amazing. VCs can be terrible. It's a big wide world out there. So, and ideally take money from no one if you can. But that's hard, especially when you're doing new things. So we've got good and bad. And if you cherish friendships, probably take the harder route and just do the VCs. Because if it doesn't work out, you might lose a few friends.
Yeah.
And
also, it's important what basically your goals are. Whether you are aiming for capitalization or to build a kind of dividend-based business, which will just allow you to take money out of the business. It really depends on your ultimate goals. When it comes to VC, they will, VC also considered as a smart money. They will bring you some expertise, and they will, make you run unless you otherwise, or either burnt out or you came to a point where your company is worth billions of dollars. When it comes to the family offices and just, kind of private money, I would say they will not add much kind of smart value, but they will let you probably run it independently and at your own space.
Yeah, just depends on which governance process you would like to have, DAO or just the guys.
Thanks you all.
Thanks a lot. Thanks a lot for the beautiful speakers. We're all here. Just one small ask that I was always asking for the audience. We're all here to bring the mass adoption happen into Web3 world. please go outside of this beautiful audience. Find at least one person who don't know about crypto, about Web3, about DeFi, and educate them. Show them beautiful partners that are here. Show them how to tokenize their assets, how to actually use the wallets to trade these tokenized assets. And this is how we can make together this mass adoption happen. Thanks a lot, and thanks for the beautiful speakers.
Thank you so much.